yesterday. So in a post on Truth Social, Trump says Powell is costing our country hundreds of billions of dollars and that we should be 2.5 points lower.
Because just hours before the conference, the president publicly lashed out at Jay Powell and said, "I'm nasty. I'm nice. Nothing works. He's like a stupid person."
This week, the Federal Reserve kept interest rates unchanged. The announcement was expected. What came next wasn't. President Trump lashed out, accusing Fed Chair Jerome Powell of costing the U.S. hundreds of billions of dollars by refusing to cut rates. At the same time, just across the northern border, Canada issued a warning of its own. If there's no deal with the U.S. in the next 30 days, new steel and aluminum tariffs are coming. The Fed is standing still, but the ground around it is shifting fast, both politically and economically. At its June meeting, the Federal Reserve kept the federal funds rate steady at 4.25 to 4.50%. Officials pointed to persistent inflation pressures and weaker growth projections. The Fed now expects inflation to hover around 3% for the rest of the year, well above the 2% target. Meanwhile, GDP growth projections were lowered, and the unemployment rate is forecast to rise above 4.5% by the end of 2025. Chair Powell explained the challenge clearly. The current environment is too uncertain for proactive cuts. One of the key drivers of this uncertainty is tariffs. Powell emphasized that it's nearly impossible to predict how trade taxes will ripple through the economy, from producers to importers, all the way to end consumers. Instead of acting prematurely, the Fed is opting to wait, watching for more concrete evidence of a slowdown before making its next move. President Trump wasted no time responding. Just hours after the Fed's decision, he took to social media to criticize Powell personally and demanded a 2.5 percentage point rate cut. His argument: the U.S. is overpaying on debt service, and that pressure isn't unfounded politically. According to data from the Treasury Department, 31.44% of total U.S. federal debt, over $10 trillion, needs to be refinanced within the next 12 months. Lower interest rates would help reduce the government's borrowing costs, especially as fiscal deficits continue to widen under Trump's economic agenda. But the Fed isn't moving. Powell and his team are prioritizing long-term inflation control, even if it means clashing with the White House.
New developments on U.S. tariffs against Canada's steel industry tonight. Prime Minister Mark Carney says Canada is taking steps to protect the steel and aluminum industries with new counter tariffs and protectionist policies.
Adding to the pressure, Canada announced it will raise tariffs on U.S. steel and aluminum if no deal is reached by July 21st. Ottawa also unveiled protections for its domestic industry, signaling rising tension between the two allies, just weeks after G7 talks ended without consensus. It's one more external shock the Fed must factor into an already fragile outlook. In short, while Trump pushes Powell to bring rates down at home, his trade policies abroad are triggering real and immediate backlash.
How long can they hide behind the fear of stagflation?
I don't think they can. Look, housing is 36% of the CPI. But in this environment, with initial jobless claims pushing up to the highest in the post-pandemic era.
Meanwhile, economic indicators continue to flash yellow. Initial jobless claims recently rose to their highest level since the pandemic. Housing starts and permits have both declined sharply, and consumer sentiment remains volatile. Yet despite these signals, the Fed is holding its ground, refusing to make a move based on short-term pressure. Critics argue the central bank is ignoring the slowdown. Supporters say Powell is doing what he must, guarding credibility and anchoring inflation expectations around 2%. But one thing is clear: when the central bank is being blamed and foreign allies are retaliating, policy stability becomes nearly impossible to maintain. As the Fed resists political pressure and the White House escalates its demands, the American economy is caught in the crossfire. If inflation remains high, Trump will blame Powell. If growth stalls, Powell will point to tariffs. And if both happen, it won't be clear where responsibility ends or begins. With Canada now joining the pushback and the Fed holding firm, the coming weeks could be decisive. The question now is not just what the Fed will do, but what will the president do next? And who pays the price if he's wrong?
President Trump and I agreed to pursue negotiations towards a deal within the coming 30 days.
Katie, what did Mark Carney need to accomplish here?
The simple answer is do no harm and really make sure that he doesn't have additional challenges to deal with that he didn't have before the summit started.
The G7 summit in Alberta ended without a joint statement. President Trump left early, and attention quickly shifted to other global flashpoints. But behind the scenes, Canada and the United States quietly agreed to a 30-day window to reach a new trade and security deal. For Prime Minister Mark Carney, it's a crucial opportunity to ease the pressure of U.S. tariffs on steel and aluminum. For the White House, it may be just another way to apply leverage. This deal is more than symbolic. It sets the stage for a fast-moving and high-stakes negotiation. Just before Trump's departure, he and Canadian Prime Minister Mark Carney agreed to a tight deadline: 30 days to finalize a new economic and security partnership. According to CBC News, Carney said the goal was to mitigate the damage from U.S. tariffs in exchange for cooperation on border security, fentanyl, and smuggling control. But here's the catch. While Canada is actively putting forward specific proposals, senior Canadian officials told Radio Canada that the U.S. has yet to offer anything in return. Carney himself admitted that having a deadline helps focus negotiations. But he also noted Canada won't wait forever. At this point, there is no signed agreement, no draft text, no mutual concessions on paper, just a handshake and a ticking clock.
In parallel, we must reinforce our strength at home and safeguard Canadian workers and businesses from the unjust U.S. tariffs that exist at present.
While waiting for Washington to respond, Canada has taken decisive action to shield its domestic steel and aluminum sectors. Prime Minister Carney announced a suite of countermeasures designed to both pressure the U.S. and stabilize Canada's internal market. One of the key actions is the planned adjustment of existing retaliatory tariffs on U.S. steel and aluminum, set for July 21st, the end of the 30-day window. The level of adjustment will depend on the progress of negotiations. Canada is also tightening procurement rules. Only domestic producers and firms from countries with reciprocal trade agreements will be eligible to bid on federal infrastructure projects involving steel and aluminum. This effectively sidelines U.S. suppliers unless an agreement is reached. To prevent trade circumvention, Canada is introducing 100% tariff quotas on select steel imports from third countries. These measures aim to block cheap steel, often rerouted from countries like China, from undermining local production. The government has also established 2 new task forces, one for steel, one for aluminum, to monitor international trade trends and advise on rapid policy responses. Additionally, a $10 billion Canadian loan facility has been made available to large domestic manufacturers to help maintain liquidity and production continuity. These actions signal that Canada is not just reacting to external pressure. It is actively building a defensive posture in anticipation of prolonged trade friction. As Canada prepares, the United States appears increasingly distracted. President Trump has returned to Washington to focus on escalating tensions in the Middle East, particularly the conflict between Iran and Israel. This shift in focus raises concern that the 30-day deadline could pass without meaningful engagement from the U.S. side. Meanwhile, Canadian steel-producing regions, especially in Ontario and Quebec, are watching nervously. The impact of a 50% U.S. steel tariff remains severe, and uncertainty about trade conditions only deepens the strain on workers and businesses. Mark Carney has emphasized the importance of resilience and forward planning, rather than relying on past frameworks or expectations. His government is treating the 30-day period not as a diplomatic formality, but as a critical economic pivot point.
I stress Canada's readiness to work to create new international partnerships to promote a world that's more secure, prosperous, just, and free.
This isn't just a negotiation, it's a stress test for Canada-US trade. Ottawa has put its proposals on the table and launched its own protections. Washington, for now, is keeping its options open. As July 21st approaches, time is running out. The outcome could define trade between the two countries for years to come.
We've seen the crude oil prices gain up by 10%, and it is 20% up now in the last 1 month.
Now, analysts estimate a security premium of up to $10 per barrel is now priced in.
You may not follow every headline from the Middle East, but if you've noticed your gas bill rising, your grocery tab growing, or your Amazon delivery fee inching up, then you're already feeling it. Oil prices are climbing, and it's not just about markets, it's about a war. As Israel strikes Iran and Tehran threatens to retaliate, global energy flows are at risk. The result? American consumers, from commuters to families, are starting to pay the price for a conflict thousands of miles away. Since fighting erupted between Israel and Iran on June 13th, oil prices have surged, up over 10% in a week and 20% over the past month. Brent crude briefly touched $78 a barrel before easing to around $75. What caused the spike? Not just the fighting, but the potential disruption. Israel has struck multiple energy sites in Iran, including a refinery fire in Tehran, damage to 2 gas processing plants in the south, and a partial shutdown at South Pars, one of the world's largest gas fields. The Ashan oil depot was also targeted. So far, no major export facility has been disabled. But markets are reacting to risk. And that risk centers on one place, the Strait of Hormuz. Roughly 20% of global oil flows through this narrow waterway. A recent tanker collision in the area, amid suspected interference, underscored how quickly things could unravel. Markets have already priced in a $10 per barrel security premium based on that risk alone. According to analysts cited by Wyon and ExxonMobil executives on Fox Business, markets have priced in a $10 per barrel security premium, purely based on fears of escalation.
When you have oil prices rise, you have diesel prices rise. I mean, that's how trucks get your and my Amazon packages, our groceries, our cell phones when we go buy them at the store.
To many Americans, oil prices are just numbers until they show up at the gas station or on a grocery receipt. A jump of $10 to $15 in oil can ripple through the entire economy. Gas and diesel go up. That means higher costs for deliveries, farming, construction, and food distribution. It hits hardest in summer. Road trips get more expensive. Weekly gas bills climb, but it doesn't stop there. As diesel rises, so do warehouse costs, shipping fees, and even grocery logistics. One week, it's your delivery surcharge. The next week, it's milk, then lettuce, then eggs. So while missiles fall in Tehran, the economic shock hits checkout lines in Texas, Ohio, and everywhere in between.
Is that President Trump would be on the phone to the likes of Saudi Arabia and the UAE to pump more oil.
Interruptions. The position of OPEC and the position of OPEC with spare capacity is that they would go in and add supply.
Can anything stop oil from climbing higher? President Trump faces pressure to stabilize prices. One possible option, asking Saudi Arabia or the UAE to increase supply. But that's risky. If Gulf states ramp up production, it could inflame Iran, which has warned, if you hit our oil, we'll hit yours. OPEC Plus has already restored some output, adding 400,000 barrels a day. But Gulf nations are treading carefully. They don't want to be pulled deeper into this conflict and risk becoming the next target. Then there's the Federal Reserve. Before the crisis, the Fed planned to pause interest rates, but rising oil prices have complicated that. Chair Powell now faces a mix of tariff uncertainty, inflation pressure, and shaky consumer confidence, all of which could delay efforts to support the economy. Markets are on edge, supply chains are alert, and policymakers are bracing for impact. You may not live in Tehran or Tel Aviv, but you'll still pay for this war. At the pump, in your grocery run, and through every quiet price hike in your daily life. This conflict isn't just military, it's economic. And American households once again are footing the bill.